And with that, I will turn it over to you guys. Welcome. And we are excited to hear all about what's going on in the world.
Great. Thank you, Matt. So 2020 is over. Thank goodness for that. What's next? What's next in this presentation are the disclosures. Matt, if you can give me panelist control here. But the disclosures essentially sum up that we are giving this presentation at a certain point in time, but granted, new information becomes available every day. So we would adjust our outlook accordingly, and this is our views based on the information that we have on hand today. All right, so moving on to our agenda, where are we now? An overview of the 2020 asset class performance and economic conditions. What opportunities do we see for 2021 and some specific investment ideas that our team is taking action on? And then how will current challenges and the ones that jump out for everybody are the coronavirus as well as the divisive politics in our country. How are those challenges going to shape the year to come? We're going to take just over 30 minutes of your time today. And if you should have any questions or any follow-up afterwards, please feel free to reach out to either myself or Brian or your financial advisor at Cutler at any time. We're always here to talk about the markets, to talk about the portfolio, and how what's going on may be impacting you. All right, so let's jump into it. This first slide here is what we call our quilt chart. And there it is. We call it a quilt chart because it looks like a quilt. Brian, when you look at this chart, what jumps out at you specifically as it pertains to last year?
So thank you, Eric, and hello, everyone. When I look at this chart, the first thing that I tend to gravitate towards is what has done the best, what has done the worst. That's sort of natural. I, of course, look at all the classes, but that is one of the first things that anyone would look at. What did the best last year? The very same thing that had done so well the year before and has been the market leader for some time now. That would be big growth stocks. Big growth stocks include a lot of the names that people do know, the Facebooks, the Amazons, Microsofts. It also includes some names that you probably would not know. That area had an extremely high return last year, and that was driven in large part by a small number of stocks. Eric's going to get to that a bit later, but we did see that leadership. That area has become particularly rich. The valuations there are stretched by any standard, so that's something to watch out for. If you drift further down that line, that far right column, what you'll notice is large value stocks. Large value stocks did end the year positive. It took some time. It took some work. They, in particular, they saw some significant upside after the election cycle, when we did confirm that President Biden, incoming President Biden, will be the new POTUS. We saw a nice rally up there. That was good to see. One other area that I look at is how have bonds done. They generally, or largely, they are near the bottom because they are not going to have as high of highs, but we have it there for downside protection. In the last 2 years now, that class, I should say, has had an outsized return relative to the yield that it provides. That is an area of some concern and causes us to want to look at very specific selection going forward.
Brian, with bonds having a cumulative 16% return in the last 2 years, would it be fair to say that the expectations going forward are closer to what the current level of yields are for that asset class?
I would say it absolutely is. So one reason why we have seen what is essentially a 16+% cumulative return for that asset class in a time when interest rates are at or near zero is that you're looking at relative yields there, right? If I can go out and buy in the secondary market a bond that has a 3% coupon or a 4% coupon instead of a 1 or a 2, I might be willing to pay up for that in order to get that additional yield. However, if you actually do the math, and bonds have a lot of math, if I paid up in order to get that higher coupon, my effective yield is not that great. But there is a tendency oftentimes for, say, a pension board or someone like that to really need to target a certain amount of yield. And what we have seen, especially in these last 2 years, is a willingness, almost a need to overpay in order to receive the sort of ongoing yield that the folks are looking for, what they're trying to target. Later on, we're going to talk about some other ideas there. But as of now, that is what we have seen is that is causing some overvaluation. Going forward, that's going to be much harder to find because most of those deals with 4 and 5% coupons, those have already come to pass.
Great, thank you. You know, Brian mentioned how large cap growth stocks have really outperformed, and that's not a new story. As you look at this chart, the light beige color there at the top are large cap growth stocks, and if you can't read it, it's about 38% last year. But that area has become increasingly concentrated, as Brian mentioned. Apple, Microsoft, and Amazon, just those three stocks alone, accounted for over 50% of the S&P 500's return last year. So the S&P was up 18%, and those stocks accounted for over 9%. The other interesting thing we've seen since the election, especially, has been a rotation out of that growth sector of the market into value stocks, and this is something that's very interesting as an investor. There's many explanations as to why that could be happening. One, Biden's stimulus package and infrastructure rollout. Those industrial, those energy, those financial stocks are well positioned for that policy change. But valuations in that sector, that portion of the market, are just much more attractive. So, that rotation we think has legs. There's also the business cycle to consider. And this next chart, I think, really shows where we are in the business cycle and perhaps explains why, we're going the wrong way there, sorry, perhaps why we've seen value stocks outperform. We had a very severe recession last year, and then a very strong recovery this year. And leading into that recovery, this part of the business cycle often favors value stocks. Brian, what do you see when you look at this GDP chart here?
So this GDP chart is incredibly unique now in that what we have seen is the sharpest, shortest recession that many of us, hopefully, knock on wood, will ever see in our lifetimes. When you dig deeper, what we see now in many of the economic type charts is you will see back in 08 and 09, that recession lasted 30 months or whatever the exact number is that someone might want to calculate. Many charts now are showing this as literally a 1-month recession. That is staggering. What we saw in 2020 was, back in January of 2020, we were at pretty high valuations. There was some concern about growth, et cetera. What we saw in February, late February into March, was a freeze on not all business, but on many businesses, many especially consumer type activities. What did that lead to? The single largest, sharpest drop in GDP on a quarterly basis that we have ever seen. We got about a minus 34% reading for Q2 of last year. That is staggering. What do we get right out of that? The sharpest rally back up that we have ever seen in GDP history at a plus 38. If you do that math though, if you go down 34% and back up 38%, you're not back to neutral yet. You're getting closer, you're going in the right direction, but you're not back to normal yet. You're not back to even. There's still some work to be done there. How could we get that 4.5%? We could get that from the pent up demand. We're going to have some future slides, ensuing slides about demand and about how consumers are positioned. But what we need is for that to happen. In order for us in this let me put it this way. Our economy is 2/3 to 70% consumer based, right? We're not a manufacturing economy anymore. We have not been for some time. We are consumer based. We need consumers to feel like they can go out and do things, and we need them to be able to actually do things. We're a $21 trillion economy. If we were to grow by 4.5%, that would mean our increase in GDP this year would be the same as the entire GDP of a country like the Netherlands. That's staggering, right? It's hard to move an economy this big, but this structure and this situation might allow that to happen.
So one other, event of the last year, and one that we hopefully will never see again, have been the job losses. And in order to get 4.5% growth this year, we're going to need to see a lot of jobs growth. This chart on the left shows exactly what happened last year, and we've never seen anything like this, likely never will see anything like this again, where we essentially lost a decade worth of jobs in a matter of weeks. If you go back to 2010, we had about 130 million jobs. That grew to over 150 million, and we dropped right back to 130 million. But we recovered a lot of that. Bryan, what do you see on the right side of the page here that kind of gives you, is encouraging or kind of gives you optimism for the upcoming year?
So like Erich noted, it took 3 months to erase 10 years worth of job creation plus growth of the society, right? We have more people, of course. We have gotten back 55+% of those jobs already. Some would say that's not enough. I would say, just like what we're going to see in some other slides, it's remarkable that it has been that fast. However, it's sort of like we got back the ones we thought we would get back. Now we need to work on the ones that are a little more iffy. If you go to the right-hand side here, the biggest bar on that chart is leisure and hospitality. As we all know, some states are much more open than others. Some cities are much more open than others, even within states. But what do we have in leisure and hospitality? There was a loss of about 8.3 million jobs. There's been a recovery back, as you can probably see, of almost 5 million. That's almost 60%. That's fantastic. Now the next step is how many of those can actually come back. Some of those institutions that those folks worked at previously are not available. Some of them will be essentially, especially ones like Disneyland, et cetera, ones like that. That's 20,000 jobs. This other place might be 10,000 jobs, but it's the ones that are going to be 4 and 5 and 10. Those are going to take longer to build up. If you slide further over, trade, transportation, utilities, a lot of that is going to be your cruise lines and more airlines, more flights, things like that. Education and health services, even though, of course, there's been much attention from the medical field on COVID treatments, et cetera, as there absolutely should be, that means there are also some other people in that field that are not working right now. How long will that take? Plus teachers, how long will that take? Many of the teachers are still working, but there could be some situations where they are not at a full-time capacity. If you go further over, what's interesting is to get deeper into this, manufacturing and construction. As I noted before, we are not a manufacturing economy. We have not been for some time, but we still do manufacture things. And of course, we build things. We need those jobs to come back because those are jobs that tend to be much more variable. Those are ones that have been impacted by the lockdowns, by the economic freeze, I guess would be a fair way to put it. And as that's thawing out, we need those to come back because those are those jobs for people that maybe don't know how to do or don't have the capacity to put it out there to do much else, right? So this is what they do. We need them to be able to do that again. But the bulk of these jobs are going to be on that left-hand side. There's over 3 million of those left. You can see we have, if you look at the left, there's about 10 million jobs of a gap between lost and regained. If you add up those first 3 columns, that's over half of them. We really need that activity to continue to be able to boost up the economy where we need it to be.
Yep, that'll go a long ways towards getting us to that 4.5% growth target that we're looking for in 2021. Absolutely. All right, let's move forward a little bit here, and I think this is a great chart. Any long-term chart of the S&P 500 gets me very excited as an investor, mostly because we're sitting here today at all-time highs, and as you can see, for the last 25 years, we've had several serious corrections. This shows the tech bubble at minus 49%, the Great Financial Crisis at minus 57%, and not quite the flash crash, maybe the flash recession of 2020 at minus 34%. And as you look back, those very severe drops really get diminished. They look smaller and smaller as stocks continue to compound and continue to grow over time. So a chart like this really puts into perspective what has happened and really makes the case for a stock market investor to continue to participate in stocks. But there's a lot of data on this page beyond just the S&P 500. And what I want to point out is, at the height of the tech bubble, we had a forward price to earnings ratio, which is a very common measure of value of the S&P 500. But it was elevated. It was the highest it's ever been at 27 times forward earnings. At the peak of 2007, right before the financial crisis, we had a 15 times forward earnings, not nearly as elevated. We sit here today at a 22, closer to 23, after the stock market has risen for the first couple of weeks of the year, multiple on the S&P 500. Bryan, that keeps a lot of people up at night, worrying that there's this elevated stock market that it's done nothing but go up, and what goes up must come down. do you have any response to people who are worried about the valuations of the S&P right now?
I think the best way to compare what's going on right now is to compare to 2000. So in 2000, we had even higher forward PEs. Those of us who were in the market back then, that was when PetSmart.com and Pets.com went public in the same month, literally. So what was happening back then? Valuations don't matter. It's all about upside, right? It's future earnings growth. But then what could I do if I got nervous about stocks? My dividend yield, if you see in that chart in the middle there in the box, 1.4, my 10-year treasury was 6.2. If I bailed out of some or all of my stocks, I could get into some treasuries, I could get effective yield that would help to compensate for the loss of hopeful upside. And I had a safe haven. If I go over to 2007, just quickly, I'll touch on that. Why were forward PEs at 15.5 there, 15.7? We were borrowing like crazy, right? We were levered up. We had way too much borrowing that could push down valuations because I could sort of mask my earnings by saying I was borrowing a lot. Fast forward again to 2020 at the end of the year there. Keep in mind also that 22.3 is us digging out of a recession, not going into one like we were in 2000. And what's the biggest differentiator? The dividend yield hasn't changed very much. 1.4, 1.6. The 10-year treasury though, 6.2, 0.9. There is not a lot of upside aside from maybe the relief of getting out of what feels like overpriced stocks, and many of them are, not all of them, many of them are. But if I'm going to bail out into a 10-year treasury, and remember that 0.9 about 6 months ago, 9 months ago now, was 0.5, right? Now, even that it's just over 1, it's still not a great alternative, right? So there's always, there can be, for most people, a place for some bonds for downside protection. But right now, it does not offer the cushioning that it would have back then.
Yeah, we use the term TINA quite a bit internally. There is no alternative. Now, granted, there are certain stocks that we would avoid just based on speculation and bubbles potentially materializing in certain parts of the market. But again, getting back to that first chart, that's not all parts of the market. There are definitely some valuations. So let's talk about opportunities out there. And really, the opportunity is to grow into this valuation. Right, we need to see the economy expand at a rate that allows us to get to that 23 times, or to justify that 23 times forward earnings. And this is my favorite page in our presentation, mostly because it is the most optimistic page I think we could put out there about the American economy, about the stock market, and about consumers. And this is really about consumers. If you look on the bottom right, household net worth in America has never been higher than it is today. So we are really at the pinnacle of wealth in our country. And people have saved a lot during the past year. During this recession that we had and slowdown that we had, people are eager to get married and to have a wedding. Grandparents want to travel and go see their kids. People want to go on vacation. All of that pent up demand has really been bottled for the last year. And as 2021 progresses, we're going to see that unleashed onto the companies that we invest in. So I'm very excited about the prospect of unleashing the US consumer on our economy and seeing what happens. There's a lot of potential there to grow into it and to really make the earnings of the companies in the S&P justify this elevated valuation that we have. Bryan, what do you look at when you see this chart?
So very first thing I do is I go to the top right-hand side, and there are some times when you can say that people do not learn a lesson. Maybe we make the same mistakes twice, etc. If you go to that top right-hand side, this is a lesson learned. Right, back in 2007, we were at 13% average debt service ratio. That's high, right? We need to have that other money out there to do other things. Now it's at 9.1. Some might look at that and go, well, there's not that much difference. Percentage-wise, that means we have cut that down by about 30 plus percent. That is fantastic work. Good job, all of us, right? If I go to the left-hand side, I want to know, where did this money go? Where is it at right now? $140 trillion of household net worth, gross net worth, gross worth, because it would be net would be after liabilities. 25% of that in houses. Okay, we know that there's been house appreciation, especially in some of the hotter markets, but that number is containable. 10% in deposits. That means there are $14 trillion in cash and cash equivalents and CDs, things like that. A lot of that money will stay in cash. A lot of that is intended to be in cash for usage and for longer term needs. Not all of it, right? There's more cash available now than there ever has been before. Not for every household. We know every circumstance can be a bit different, but by and large, money is available. And like Erich has said several times, people want to do things. We just have to be able to do those things. Then we go down to the bottom, 41% in financial assets and 20% in pension funds. Both of those are available for activity, right? I do not have a locked up net worth here. I don't have 50% in houses. I'm not in a housing bubble necessarily. I am in a situation right now, we are in, where there is accessible funds. There are accessible funds that can be used for these discretionary needs, and people want to do it. They just have to be able to do it. Go to the right-hand side of that chart, 66% of liabilities are in mortgages. That's good constructive debt. Many of us get some relief on that from deductions, et cetera. That is not bad debt. There are a few items on there that individual specific people will need to clean up, but by and large, if you look at that balance sheet there, and since then, that's a Q3 on the left, Q4 on the right, it's risen up even more since then. It puts us in a good position, right? We're not trying to maintain a lot of debt. We're not servicing a lot of debt. We have discretionary income. We just need to be able to use it.
Great. So yeah, that's opportunity number one, is really the opportunity to unleash the consumer on our economy. Opportunity number two, we see equities, international equities, as really opportunistic right now. And when we started off the presentation, we talked about the rotation of growth versus value, and growth in many ways are technology stocks. And there aren't many economies in the world that have the technology stocks that we have in the United States. Really, the only one that comes close is China. So when we look around the globe, we see value in Europe, value in Asia ex China, specifically for several reasons. But one of those reasons is the types of companies in those economies reflect what's also doing well lately here. I mentioned industrial stocks, financial stocks, energy stocks. Those types of companies have really done well over the last several months. They have lower valuations than the growth space does, and they're also benefiting from what has been a weaker dollar trend of late. And we think that weaker dollar trend could continue as 2021 progresses. So I would just highlight the global diversification as a 2021 opportunity, and looking forward to seeing that play out as the year progresses. Bryan, I want to bring up a chart here that does include those international positions, but what it shows are the interest rate or the yields of these various asset classes. What jumps out on you on this page?
So starting from the start, from the top and working down, right now, the environment that we're in, those of us that do this know, to take no risk will provide no yield, no real yield. Short-term treasury bonds via this very highly used vehicle, the ticker there in the middle, has an effective yield of 0.09. That's actually up to 0.09 from what had been 0.05 or something along those lines. You're not going to be able to do a lot with that, right? What do we need to do? We can, in the world of bonds, the discussion I have with clients a lot, you can either go longer in duration or lower in credit quality. Well, the first one, let's look at longer in duration. Long-term treasury bonds, 1.44. What I can tell you with that fund in particular is when you're looking at 20 plus years of duration, and I won't bore everybody with that discussion right now, but basically your swinging is going to be a lot wider. That's not necessarily what you're looking for. Instead, let's look at the world of corporate bonds. Corporate bonds from good, high quality issuers have a yield of 1.86% on this vehicle. That's pretty darn good. That's almost twice the amount of a 10-year treasury. How about high yield bonds? High yield bonds, junk bonds, have a yield of 3.6. However, a word of caution, high yield bonds are that for a reason. They're coming from issuers who are not exactly the most credit worthy. So let's do a comparison. High yield bonds versus two lines down below that, large value stocks. A 3.6 from a junk bond or a 3.2 from what is by and large a high quality, long-standing bedrock of the economy type fund or type company. I think I would probably err on the side of caution there. So if you go down even further, foreign developed, right? What is a great thing about non-US stocks, developed non-US stocks? They have historically and still today pay higher yields than we do. Eric noted on the page before, right? Lower valuations and a weakening dollar, et cetera. All of those can help that area. If I can get a 3.5, I'm now at almost 4 times, over 3 times the yield from a 10-year treasury. Okay, now we're really getting somewhere. Emerging markets has the opportunity for more upside and the stock price situation, plus gives me a yield of over 2. Once again, that's over double the amount of a 10-year treasury. There are ways to construct portfolios for stock upside plus recurring yield without having to take undue risk.
Bryan, in the bond space, it sounds like you're saying don't just buy the highest yielding bonds out there. In the stock space, are we recommending buying the highest yielding asset classes? I mean, it looks like, according to this chart, we might be.
I'd say yes. I think the coincidence of how that's come together is that there has been a reach for yield in bonds, and there's been a hesitation against yield almost in stocks, right? There's been like, oh, yeah, I could get my 3.5% yield from some of these really good high quality stocks, but instead, I think this stock might go from 30 to 35 or whatever it might be. Mm-hmm. Capital appreciation is always going to be a good aspect of return, but there also needs to be a consideration of risk and of valuation stretching. On the bond side, I think what we do here is you want to look at a kind of a tempered enthusiasm for some of these yields, right? The default rates for things in the high yield space for some of those issuers is at or near, maybe not, I wouldn't say all-time highs, but they're very much elevated from where they have been. That was expected going into this crunch, right? If I'm a levered up business that has to issue a bond at a 7% coupon, for example, there's a reason for that, right? I'm not doing that because I want to. I'm doing that because I have to create the kind of capital that I need for whatever project it is. A lot of those are not coming to fruition now because there's a lack of interest or a lack of access to those projects. Default rates are going to climb there. So I would say that that is true, right? That we're looking at the best valuations in stocks also dovetail together with the higher yields in stocks. On the bond side, high yield, the spreads that we would call it that we're seeing now are not wide enough for me to say with conviction that it is worthwhile to take that additional credit risk.
Great. Well, let's take the last portion of this presentation and talk about challenges, because we're definitely in a position where there's challenges out there. And the first challenge here, if I can stop on the right slide, is the rollout of the vaccines. And one thing I want to preface this conversation with is, the start to finish of this vaccine process is really the current era's moon landing. I mean, it has been an impressive undertaking. And yes, there's been frustrations with the rollout of the vaccine, but as this infrastructure gets built, there will be more and more vaccines administered, and that infrastructure really will be put into place as the year progresses. So when we get back to those earlier slides of unleashing the consumer, we have confidence that as 2021 moves forward, we'll see more and more economic activity because of the vaccine rollout. Bryan, how do you feel about the vaccine process and kind of where we sit today?
I know there are lots of headlines. There's always many headlines when many of us are at home all the time or much of the time, right? So the news cycle gets compressed, the expectations get heightened. The first thing I would say, including some people that I know personally that are involved in this world, thank you to everybody for rolling out multiple vaccines within a period of months rather than literally decades that it has taken in the past, right? What Eric said is exactly right. This is our moon landing, right? The amount of work and the amount of infrastructure that it took to put this all together is jaw-dropping, right? There is no equivalent that I could ever imagine, since I wasn't alive for the moon landing, in my lifetime than this. What does that lead to now? I mean, I know here and other states, other countries, other places want to get out and get back to the world, as we've seen on multiple slides. We need to get back out and get into the world from an economic and a financial standpoint. But what this tells me is there is a timeline, there is progress. Yes, there will be hiccups from this day to that day, this state to that state, this country to that country. That's just the nature of people, right? We want it right now because we know it's there. It is there, it will get there. This process has been an incredible success. It just happens that it's in a time when it's impossible to not get bombarded with news about this on a minute by minute basis, unless you just turn off every device you have. Maybe that's a good idea. We can't really do that here, so we see this all the time. This will happen. This is happening. It's been an incredible success. It's been incredible partnerships. Now let's get to work, and once this is done, then we'll be able to see the light. We can see that light. Let's get to the light at the end of that tunnel.
All right, challenge number 2 is the Fed. And, it's interesting that we list the Fed as a challenge because in 2020, the Fed's intervention into the markets was a huge success. How has that changed? Why are we listing the Fed as a challenge now as opposed to an opportunity?
So when I look at this, the opportunity that the Fed provided us with is a cushion, right? I mean, when this first came out back in February, March, April, we expected that an act would come out. It was the CARES Act. That was the first round of this new stimulus. And it really was a bridge, right? Essentially, the rug got pulled out from under us. No one here that I know of, expected it to get to the level that it did from the actions, the choices that had to be made to try to remedy, the virus spike. So what happened? We had to have an intervention from the Fed. The Fed came in, Chairman Powell and the regional chairs, and said, we will do what is necessary. We've continued to follow that path, and that is great. However, what has been necessary is to provide liquidity that would not be there otherwise from the businesses that were not able to operate. Okay, how did that play out in dollars? If you look at this chart, QE, quantitative easing, 1, 2, and 3. First happened over a 6-year window. That was 2008 to 2014. This one has been over about now a 10-month window. Okay. First, those first 3 rounds from back when added up to less than $2 trillion in new treasuries. This round has been over $2 trillion in treasuries, plus the potential for more. This then leads to that word you see in the title on the left-hand side, inflation. Inflation has been a bit of a false start. There's been some shadow expectations of inflation for quite some time now. When you look at inflation, though, there are multiple aspects, but really the big 3, the cornerstones are energy, food, and housing. What have we seen during this entire period of time, during this low to 0 interest rate environment? Food and housing have been on a pretty normalized track, +2, +3, something like that, depending on location, depending on preferences for food. But the objective of this measure is to normalize that. What has dragged down inflation mostly? Energy, right? The price of a barrel of oil went from $140 to, at one point last year, through some strange sort of transactional things, a negative price. But really, what is the price of a barrel of oil right now? In the high 40s to the 50s. That's a big difference, right? The price of a loaf of bread, et cetera, the price of your house or your rent has not had that same level of fluctuation, especially on the downside. What could drive up energy? A lot of free cash, a lot of pent-up demand. Again, a lot of really the need for some businesses to try to recoup some of their lost expenses, their lost revenues, I should call them, by perhaps nudging up prices. But what's going to be the biggest crux here, I believe, is going to be that energy price. If that goes from a pull down to a push up, that can make some difference. Now, I wouldn't look for Venezuela type inflation. We're not in that. We're not in the late 70s inflation. There just aren't the forces in place there. But the chances of it getting back to a more normal track, maybe even a little bit above that, I think that's a fair possibility.
Well, and the Fed's going to let inflation rise. That is part of their stated objectives right now. The Fed has announced that short-term rates they're going to keep on hold at least through the end of 2023. So your savings accounts, your short-term bonds that are essentially getting you 0% today, that's not likely to change in the near term. This chart is really discussing maybe the long end of the curve, where the Fed is doing a lot of purchases still that suppress bond rates, at farther duration. And the Fed has the ability to slow down those purchases. So you'll notice in 2021, this curve is still going up. The Fed is still out there buying bonds today. So the first thing they will do is to stop those purchases, let rates rise a little bit to kind of take some of the heat out of the economy. But if you look back over the last decade, the Fed intervening the way that they has been very positive for stocks. So as we sit here today, the Fed is still very supportive for stock prices. And I think that's both a challenge as an investor because of those long-term issues and that long-term inflation possibility, but it's definitely an opportunity because it supports stock prices in the near term. All right, so let's dare to talk about politics on a webinar here, Bryan. And I know it's what all of our clients want to talk about it, and it is relevant. So we don't want to deminimize your views and kind of how you feel about what's happening out there, because it's very significant. But at the same time, I do want to say the stock market does not care about your politics. And, you know, I say that flippantly, but this chart shows really what has been a phenomenal couple of decades for the stock market. Yes, we've had some bear markets during this time period. But what it does show is the lens with which we all look at the economy and look at the stock market. And we just want to highlight to everybody that if your guy is in charge or your gal is in charge, you have a different view of things than if the reverse were true. So during the Bush era, Republicans were very excited. During the Obama era, they were not. And then for the last 4 years, Republicans have been very excited. Not quite as extreme, but you see those same trends with the blue line on this chart. Bryan, you want to jump in with any other thoughts on kind of how we all look at the stock market through a political lens?
Absolutely, yes. I mean, I know we get questions all the time. What should we do ahead of this election, or what should we do after that election? We're going to show you exactly what has played out in those scenarios, but there is always going to be emotion tied up in these sort of activities. And ultimately, what I would say is just what Erich said. The market doesn't care about any of our politics, and that especially includes mine. Here's the red, here's the blue. Mix it together and call it purple, and that's fine. Ultimately, what I see on this chart that really is a crucial driver for us going forward is, if you look at the middle dot at the very right-hand side, that's the total out of this very large data set the Pew Research Center put together. 3 out of 10, let's say 33 out of 100 people voted or said that they feel that the state of their confidence on an economic standpoint is excellent or good. All right, well, 33 out of 100 is not good enough to get us to the kind of economic activity that we need to justify everything we've talked about now for many of these last 12 slides, right? It's not going to work if only 3 out of 10 of us feel confident enough to go on a trip or go buy the thing that we need to buy or do the other things, right? We need that number to go up. Whether you are elated or dejected about this latest round of activity, you were probably the reverse of that 4 years ago. Did that stop you from buying things? Did it stop you from buying things 20 years ago? The historical numbers would say no, right? But once again, 33 out of 100, 33% is not going to get it there, right? We need that number to go higher for everyone and anyone.
Well, and this page really sums up that previous sentiment with numbers. You can see for the last 45 years, we've essentially had alternating political parties in charge in Washington, at least at the president level, since 1988. We haven't had consecutive one-party control of president from one president to the next. So you can see, we've had a pretty good sample size of both parties having control in Washington, and yet the returns have been nearly identical for the last 45 years. Divided government has been slightly higher. But if we have one-party control, which is the case today in Washington, D.C., or at least next week in Washington, D.C., we have nearly identical return expectations with a Republican-controlled Congress and presidency. So, this really does sum up why we don't recommend, investing around the current political environment. Now, there will be proposals that come out. There will be tax proposals. There will be regulation on specific industries that we will recommend positioning portfolios around. That we do think is sound, but this really answers the question, should I, if I disagree with what's happening, or if I'm worried about politics, or if I'm excited about politics, should I ramp up risk? Should I, ramp down risk and go to cash? This unequivocally answers that question. No, you should not. You should go back to that quilt chart, go back to the first page and say, what is my asset allocation? What's the right mix of these investments for me? And stick with that. We've been advocates for sticking with your plan for a long time. plans do change, they adjust, and we can adjust those plans along with you. But knowing what portfolio you're in and why, that's really why you're with Cutler. Thank you for being a Cutler client. And we advocate sticking with that plan, regardless of how you feel about the current climate in Washington, D.C. So with that, I just want to thank you all for your attendance today. And Matt, do you have any closing words to?
Yeah, thank you, Eric. So we put the phone numbers up for each of the offices if you'd like to give them a call. I also would like to just point out, we did have some questions we weren't able to get to. If we missed you, we're sorry. We will circle back around. Either your advisor or one of the three of us will be calling you. So thank you for putting those questions in. Thank you for your participation today. We look forward to hearing what Bryan and Eric have to say when we are all immunized in 30 days. Thank you, everybody, for joining us. Thank you for your support here at Cutler, and we look forward to talking to each of you soon. Have a great day.
Thank you, everybody.
Thank you very much.